I'm David Tinsley. I'm the head of LSP Services with Lenders Cooperative, and in this webinar series, I'm going to be discussing the recent procedural notice from SBA regarding the sunsetting of the SBSS score for 7A small loans. We'll be talking about what the notice actually says, how it will likely impact 7A lending programs, and also discuss things that you should be thinking about as you approach that March 1st effective date. So SBA sent out a procedural notice. This was on January 16th, and we're dealing with a March 1st effective date, right? But the title of it was the sunset of the SBSS score for the 7A small loans program. And I mean, it's clearly stated in there, right in the first paragraph, that this is to announce that they're discontinuing the use of the FICO small business scoring service. This has been in the last several versions of SOP and been a part of the 7A small lending program for some time. And generally, lenders could rely on it. SBA communicated it in the SOP directly that this would serve as proof of the repayment of the loan, that it could be relied upon, and in some ways it stepped in and counted in place of what could have been other steps the lender would have taken had this not been available to them. It kind of points back to CFR has always required, it's 120.150. It's always required prudent lending standards. You know, the lender was required to compare their 7A program to their non-SBA program, right? For loans of similar size and purpose, if you were looking at that, saying, well, this is generally what we did and what we considered prudent, and then SBA said, well, hold yourself to that standard. And we saw a big move in the 5010.7 and 7.1, and it got dubbed throughout the industry as the do what you do standard, which ultimately SBA wasn't happy with in the long run. We saw a lot of early defaults. There was sort of a let's return to prudent lending, right? And so you kind of had that communication happening all throughout last year, and SBA was attending the various regional and national conferences. I mean, they were signaling ahead of time, do something about this, or you're going to see some changes demanded. And all at the same time, it was no secret that a lot of lenders were using this ETRAN SBSS scoring service as the pre-screening tool. And SBA was communicating, don't make that your first step. You determine internally that this is a loan that you wanted to do. And then from there, you could, then you submit it through to ETRAN. Then you would get that score and confirm it. And so I think they were seeing a much lower kind of success rate, right? Like, so, I mean, you're seeing out of 1,000 submissions and you're getting scores, how many of those are actually turning into loans? And from their perspective, I don't think they were seeing anywhere near the level they were looking for. And so again, it should not have come across as a surprise. I think they were signaling ahead of time for some time that this was coming, although I don't think everyone expected to go quite like this. I think there was sort of we're replacing it with this, or there's now going to be a fee for running this, or what have you. So it's a bit surprising in that way. But as far as when it comes to how SBA wants you to do 7A small loans, the fact is they want the loans to perform. And so we've seen what it was like over the last couple of years. If the lender is just making the loan and they're seeing early default rates much higher than they were wanting to see or expecting, then obviously it's, what is it, the old definition of insanity. If you keep doing the same thing expecting a different result, that is the definition itself. And so obviously something had to change from their perspective. So all of this is in line. It makes sense. I don't think it signals some sort of a move against fintechs, or even a kind of a modern new approach to lending. It's not saying you cannot score. It's not a ban of it, but it is saying prudent lending is going to ultimately be the standard. And what's the ultimate way to determine whether prudent lending is being done is, do the loans perform successfully? Which unfortunately, you can't make that loan decision today and know for sure. You got to jump ahead several years and look at it and see, well, how did they perform? I think it's clearly in line with the communication they've been giving us as lenders, as an industry. I think it's actually signaling you as the lender now have some choices to make. Again, not a prohibition or a ban of using scoring. Aside from the clear communication, it can't just be a personal credit score. That can't be the only factor. You would have to use some other factor in addition to that. And of course, there's way more. There's several other things, because they've gone back and sort of replaced the language in SOP when it comes to what's expected in the credit memo, that level of analysis. But we can go into that in more detail later. But ultimately, what it boils down to is this is going away. So the free tool is going away. SBA's reliance on it as allowing like the lender to be able to use that as their primary proof of repayment. That's gone away. There's going to be other steps as a lender that you have to do, and ultimately, if it's, I think the big thing there is you can't just do a quick like score look. SBA is expecting you to do some level of analysis in there to be able to show we're taking the extra step. We're looking at a few things to make sure that this business, the project, the repayment of it is ultimately reasonably assured, and that's not going to be just by use of a score. Okay, so with this notice, there's some language that's going to replace the current SOP, the 5010.8, with the technical updates. The language in the SOP specific to this underwriting 7A small loans, it's a section that's going to replace it. And of course, with the removal of the SBSS, when it comes down to is they call it your when you're underwriting the loan, most of this is going to come down to what your credit memo is going to actually tell you about the loan, which is your justification, your approval, your rationale, the sort of everything that went into the why of the loan and how this ultimately assures that repayment. So the first section of it is kind of standard. You're looking for credit history. This can be established with a score. I mean, some of this can be covered in that because it gives you that background, but ultimately you're looking at some sort of an analysis of the applicant. And when you say business applicant, you're meaning it's the operating company. If there's an EPC as part of that, you're looking at the relationship between the two of them. But the explicit requirements that are laid out there is you're going to have to do a debt service coverage, and you're looking at the most recent year as well as the 2 most recent months of commercial bank activity or statements. And then if applicable, you can get projected earnings. The debt service, it calculates it. It defines it for you, which means the operating cash flow. It's kind of standard across lending. You would look at an EBITDA, and you can make the reasonable additions or subtractions to it, but you're going to want to follow the rules in the standard 7A program for that. So at least that way, across small or standard, those are pretty consistent. And when it comes to debt service, it's any of the future required principal and interest payments on a business debt. And obviously you would include the new loan in that. As far as the debt service minimum, this is different than the historical standard 7A because you're only required to reach a 1.1 times debt service compared to the larger 7A program, which is 1.15. And then you got to speak to things like insurance, and you would specify certain other things depending on whether it's applicable. But if more than 50% of your loan proceeds are going to be working capital, you have to justify that. You talk about things like if there's seller financing, are there any liens or judgments that are out there? If it's a franchise, you have to do the extra steps around the franchise. And then, of course, you cover things like if it's debt refinancing, you got to include justifications and original purpose around that. And then you also want to talk about the effect of any affiliates that have on the repayment of the loan or the repayment ability of the applicant specifically. Much of this, if you were comparing it to previous sections, much of this is the same. This is not really truly different. The big key changes in there are the fact that you must do a debt service now. That was not strictly required in the previous. And in place of that, you were explicitly allowed to rely on the score. So again, that piece is gone. You got to look at the most recent 12 months. You're looking at a 1.1 times debt service or debt service coverage ratio. And then in addition to that, the other new factor is the 2 months of bank statements, which this might come as a surprise to some SBA lenders. The only time you've ever had to capture 2 months worth of bank statements previously was when you were doing something like verifying an equity injection. And that was an entirely different purpose. There, you weren't necessarily worried about what money was moving in and out. You were trying to see that there was money that was available that whole time, so that you could consider this as cash that was available for injection. So it's an interesting move. I think we'll probably cover a little bit more what you'd expect to see. Like, okay, I've got 2 months of statements. What do I do with that? I've got thoughts on that as well. But I think just from an industry standards practice, I think it's a good move. And just something that occurs to me that the thing about using a 12 months, statement, a year of a financial analysis on there, if you're using something that's validated, traditionally in the SBA space, that would be a tax return. So depending on the, it might be February or March, right? And you wouldn't have necessarily the previous year's tax return filed yet. So that means you're actually looking at something that at least is 14, 15, 16 months old versus if you're looking at an account activity statement for the last 60 days, that's very recent by comparison. And so there is something to be said for a smaller business getting a lot clearer picture by being able to have more recent activity. So I think that's a prudent move. And also at the same time, if you're looking at a score, oftentimes the things that are the most impactful to a credit score are things that happened recently. So it might be that I've been looking at a statement. They look like they had a really strong year, but what I'm actually looking at is activity in 2024, but it's 2026. So I do think there's a lot of ways that can help bolster that, and also I will point out that it doesn't specifically state that it has to be the most recent year of a tax return. That is kind of interesting. That so I think from a prudent lending perspective, it makes sense that you would want to get validated information. So I do think that is consistent with SBA. Getting something like a tax return does make sense. As a lender, if I'm looking at that, would I probably get a tax return and the most recent interims, even though that's not strictly required? Probably. Would look at that too, and it would at least let you see some consistency and know that in the interim things haven't taken a material turn one way or the other. And then of course, ultimately you have the option to use projections if you wish. And I would hold those to a similar standard. I mean, if I'm going to rely on projections because I don't like what I see from a historical perspective, I don't think you could just take those numbers. It would make sense that you would want to get what are the underlying assumptions to it. And then, of course, that opens up the question of do I have a business case here? Is there a business plan that I'm using alongside that? So really, I think it gives the lenders a lot of opportunity to just apply their own prudent standards. I mean, truly, as a lender, if you want to look at it and say that I'm comfortable with seeing this cash flow activity, I'm comfortable looking at this in combination with this business scoring model that we use. Either it's internally grown or perhaps it's one in the industry that's well thought of. You could do something like that, and then all of those together, if it paints a picture that you could say, yes, we're comfortable with the repayment ability being reasonably assured with just this analysis. I mean, ultimately, the proof that you'll have is a performing portfolio. The SOP, the beauty of this is that it sets out the minimum standard you have to meet. You're always free to exceed that standard, but ultimately, if you're meeting the standard, SBA is going to hold you to whether or not that portfolio is performing. And if it does, I think you've found a way to be able to be efficient, continue a small dollar program, and meet the spirit and letter of the requirement. Okay, so the guidance says something very particular, and I think it's worth noticing. It's 2 most recent months of commercial bank activity or statements. In the connect call, the idea of this bank activity versus specifically saying it's the statements, I think the intent there was specifically so you could use something like a third party, and they actually use the phrase plaid-like vendor. So it's not necessarily that you have to go to your bank, give me my January and December statements. It doesn't necessarily have to be that. So if you have access to online banking or something, they can perhaps give you, a printout of 2 months or the last 60 days of activity. So just to be clear, it wasn't wooden. It was intentionally sort of expanded language to make this easy. And in some ways, I think give you more freedom as the lender on how you wanted to handle. But then the question you have to ask is do you have a policy and guidance covering what to do with those statements? I mean, if you don't have that internally, well, number one, if you have it, follow it. I mean, that really comes down to the do what you do standard. If you collect 2 months of bank statements for your non-SBA loans, do the same thing, follow that guidance, and that typically is going to keep you out of trouble. If you don't have a policy for that, write one. I would say put something in place. This is what I expect internally, this is what we do when we receive 60 months of account activity as part of the determination of a credit decision, right, for an application. Here's what we do with it. Because otherwise what will happen is you're stuck with whatever SBA decides is prudent at the time that they review it. You're way better off giving yourself permission to follow some steps versus later not giving any kind of indication of what you were going to do, and then SBA deciding, well, I think you should have done this. I mean, it doesn't necessarily mean you automatically will get into trouble, but why risk it when it could be as simple as here's the guidance we're going to follow internally. But I mean, things that you can look at from a statement are things like, how consistent are deposits, right? you've got some sort of a 12-month activity or history that you're looking at from the business operations. So do deposits match with that? If they say that, if they say that they're collecting over 500,000 in revenue, does it look like account activity would support that? Now, it doesn't automatically mean that number is wrong or that something detrimental has occurred in the interim. It could be seasonal. There's could be lots of explanations for it, but the fact is, you kind of have proof that something's going on. That represents 1/6 of their operating year, so you ought to be able to see some activity there. Is the activity regular? Is a lot of small transactions, or is it is it just a few very large transactions going on? Is it from a single source? I mean, is there a big concentration risk because there's just one client that they're working with? Things like that you can readily see over a 60-day window. And also, kind of pointing back to it, you're not limited to 60 days. If this is easy for you to obtain and the guidance you have allows you to do this quickly, you could take 90 days. You could take 120 days. If this analysis is simple enough and you can quickly gather 12 months of activity that you can sort of reconcile with activity on income statement, more power to you, right? If you're able to do that quickly and easily. So again, minimum standard, but you ought to be able to see these things relatively quickly, and it doesn't necessarily take a lot of analysis to do that. And when it comes down to it, you're really looking at the timing of cash flow versus the timing of the debt service. Remember that your debt service coverage ratio, when you calculate that, you might look at that and go, okay, so they have 1.5 times or more, maybe, as far as debt service or operating cash flow that's available. At least it appears from there, but that doesn't mean the timing of it matches up the same. So the question that it comes down to is the money available at the time that it's needed to be able to meet those obligations? And you can more easily see that. You can see things like, when's the rent due? Are they paying that timely? Is payroll regular? And another thing is you can actually see the loan payments on there. So if they have an existing debt of some sort on the books today, you can see, is the amount they're paying, does that match it? Are they overpaying that? Because that indicate that things are in an even better position for them, right? You can see that. Another thing is, are there red flags in that time period? Do you see chronic negative balances going on there? Or is it the sort of thing that this check would have bounced if this other money hadn't gotten here in this time, right? Is it just in time? All of those, again, can be kind of fairly easily seen without too much of an in-depth. And ultimately, the question you're answering when you're doing this is, can they pay when payments are due? So that's the purpose of it. Something else to think of, you could easily see if there is owner support, or maybe there's intercompany transfers going on. Again, not automatically a negative thing. I want to see an owner supporting the business. What you don't necessarily want to see is an owner having to support the business because it's not doing well, right? It could be seasonality. Like, again, there's often answers for this that are very simple and straightforward. What you can't do is have information that suggests there's a question that should have been asked and then not ask the question. I mean, ultimately, you're left having to answer SBA going, this was an obvious thing to us. Did you see it? And then you either have to say, no, I didn't look, I didn't see it, or I did see it and didn't bother to ask, right? So in either case, that could be problematic. And then other kind of positives, you can see that, I kind of already mentioned it, but you can verify their debt payments. If they have a debt schedule and they're saying, I'm making these 3 payments each month, you can see them. Are they? Great. Okay. Like, you just validated some things. That's never a bad thing. And something else, like, not to put too fine a point on it, but you can see their starting balance, you can see their ending balance, you can see an average balance. Does this speak to a company that's operating well and has sufficient cash flow? Does it have sufficient kind of working capital reserves in place? And then one other caveat is, I understand in this modern day of banking, they might not have one account. Something else you need to consider is that, and again, this speaks back to having policy and guidance. Which account are you going to get? If they have one that here's where we put money, like, it could be that they're having money that they set aside for a purpose, right? So that's not going to necessarily be in the operating account. Or it could be that our debt payments are made out of this account over here, and so we transfer money throughout the months to do that. Are you looking at that account? Or are you looking at the other one that all the revenue comes into? So here's where the deposits are made. It could be that there's a sweep involved, so this thing goes to zero every night. Well, that's not necessarily the account you want to look at. So what it comes down to is, you want to make sure you're defining from your policy, this is how we see the operating account for the business. Because again, it just says the 2 most recent months of commercial bank activity. And I mean, presumably you're talking about the operating company, right? But again, if you don't define it, if you don't give yourself permission and the specific steps that you're going to follow, you're left with SBA coming back and saying, here's what they feel is prudent, right? I mean, they could still question it, but generally speaking, their approach is so long as you are following your internal policies, and especially if those policies are consistent with your non-SBA lending, you're going to be in a lot less trouble. And you're going to tend to, and obviously the unspoken thing there when you're doing that is like, this is probably, if you're willing to lend your own money out this way and you have a successful portfolio in that, then that probably means you're following prudent standards. And ultimately, that's what this is all about. Yeah. So I guess depending on how you look at it, this is absolutely good news. Some of the things that I could see frustrations previously is that SBA expects the lender, right? So they expect you to use your prudent lending standards. They expect you to go through the process of looking at this and saying, yep, we would make this loan, but for one of these acceptable credit elsewhere reasons, and you put it together and send it. And then previously each man would come back and say, sorry, you're below that score number. And you're like, well, I'm comfortable with this loan. And you're stuck with either, okay, we'll do it either as an express loan, which is a lower guarantee. And I mean, the fact is, if you were comfortable with that, you would have done it that way. You would prefer to have the higher guarantee, but your only other option was effectively treat it like a standard 7(a) loan, which could have been a lot more effort for the part. And that can be a difficult hurdle. I mean, historically, we were watching prior to a lot of the changes that occurred in 5010-7, we were seeing the average loan size creep up from, you go back like 10 years, the average loan size was, I think, in the 300 or under 300,000 or less range. And as you were moving later into the late 20 teens, you saw it go up to almost 1 million, I believe. And whether those numbers are perfectly right or not, the clear story was the average SBA loan was getting higher and higher and higher, which in many cases, I think it was a 2023 survey they did with businesses, like 90+% of the financing need for small businesses was under 250, right? So the lenders, because of whether they were real hurdles or perceived hurdles or whatever the case may be, lenders were feeling like getting those small loans done were more effort than they could accommodate or justify, right? So so the SBA wanted to move in that direction of the small business was not feeling so small anymore, that it was these businesses were getting larger, and you're seeing average sizes of almost $1 million. So I mean, that was the spirit. That was the move into 5010-7. It's like, if we make this easy, we do more of the small dollar, and we certainly saw it. But the problem is that it was a lot of loans the SBA didn't want to see, because there was some early defaults. So is that bad news? I think it's a correction. It's a hold on now. We want you to make the small dollar loans, but we want you to make good loans. Like, we really want you to take the time to make sure these things are going to be repaid, because ultimately, while you're doing that for while you're making the loan for the small business, you're also looking out for the SBA's interest in this. And ultimately the SBA it's the small business that they're interested in. So we don't want to help companies be set up to fail. Right? As an industry, the goal is to help the small business owner. And part of that is taking the extra step, looking at it and saying, is this the appropriate time? I think most lenders, when it gets down to it, they really want, I think in speaking with it, it's a very rewarding process to get to be part of helping a small business achieve something. That is, is it more appropriate for something like the Small Business Administration to get out there and to foster that economic growth? You're talking about employment. You're talking about things that were ideas not even 10 years ago, right? And now it's a business. It's a thriving business, and you get to be a part of that. And I think that's why when it comes to SBA lending, that's why most of us do that. There are easier things to do in lending, for sure. And so getting to be a part of that, right? That's why we do it. And as I've often said to the members of my team and others, I don't want to help someone lose their home. I don't want to help someone lose their business. And so a lot of times, if the answer isn't yes, many of us aren't satisfied with saying no. What we want to do is be like, not yet, right? So what helpful feedback can we give them? And we want to see them come back later and be ready and be successful. That's what we all want to see. So is it good news? Yes, if it's approached the right way. There were plenty of loans that I felt like I've seen that we wanted to do or be a part of, and then what would end up happening is it would just miss that score by a point or two, which means there's a lot of extra work to get it there. And this is SBA's way of saying, here, the hurdle is still lower, right? And they had to put a minimum threshold somewhere. So look, at a minimum, do this much, right? So it's the 12 months of activity. They're looking for the debt service coverage. They even lowered that a little bit. You can use scoring to establish like the credit history of the business, and that's great as well. And then you've got this whole 60 days worth of account activity, which I think that really leans into a fintech mindset of I've got all this data and I've got all this account activity that we can look at and say, what can I do? What can I look at for that to help be predictive, right? And so I think if approached in that way, SBA is being clear. This is the minimum we're looking for, but ultimately, I think it's allowing some freedom to come back in to where that deal that you saw, right, that didn't meet the minimum 165 of late, that it came in at 163 or something. There are reasons that perhaps minimal score or limited scores that you're working with are a good risk. There are, you've got the other information together, you've justified this, but you don't want to have to go and meet that extra hurdle to get all the way to the standard 7A level. So in that sense, it's very good. And you're not having to have this extra qualifying step that's out there. Whatever process you put together internally, it's yours. You've proven the decision. SBA says we'll let you use that. You're not then sending it through E-Tran and crossing your fingers and hoping I get a minimum score. You've already done all that in the process. So to me, that is good news. I realize that not everyone will see it that way. And like any other change, you've probably got an efficient process already in place that you got to go back and kind of relook at it and decide what needs to change here. What do we need to prep for that? And so it's really going to be a thoughtful approach. Ultimately, the question you're answering hasn't changed. Is repayment reasonably assured? Why yes to this business? Right. And ultimately you're still answering that question. I do like the fact that SBA is giving you some freedom in how to do that. And I also like that there's some guidance with it. Previously to that, I mean, there were plenty of lenders out there that felt like, were you really saying you don't have to cash flow? And we know that's not what they're saying. Yes, you have to cash flow it. Take a look at it. So guidance is typically more helpful than none. And then getting a feel for what it is that SBA is really wanting out of that. I think there will be much to learn in the coming months. As we hear from SBA, as they talk about more feedback around what are other lenders doing with these 60 days of bank statements. I think that'll be helpful. And but yes, I do think there's reasons to be happy about that. You'll just have to be thoughtful in your approach.